It's a great pleasure to be here. Awesome that you are continuing to organize this festival in times like these, especially even more important than ever before. I'm really excited to be here with the panelists today. We're talking about something that everybody cares about, and at the end of the day, at some point in time, really needs to think about. That is the investment, and if you do need an investment to grow your enterprise, your startup, or whatever the situation is that you have. I would like to just say a few words briefly about myself. I'm a passionate entrepreneur. I love being an entrepreneur, and I really care tremendously about it. I've dedicated my life to helping entrepreneurs and empowering them to succeed in creating solutions to the real life problems, but also to the big challenges of our time, as I believe that entrepreneurs are the ones who are creating the solutions in the world. And I come from both sides, supporting entrepreneurs in terms of the, as Nora mentioned, the 1 Million Startup, which is a platform for entrepreneurs that are working on the Sustainable Development Goals and creating a full ecosystem around and promoting them. But also on the other side, I am the founder of the Austrian Angel Investors Association, so coming from the angel investing side, and also recently just was elected as vice president of the European Business Angel Network. That means that I really talk from both sides. I've spent a lot of time with different institutions and organizations and funds working on investment and how we can help entrepreneurs and how we can fund entrepreneurs. And I'm really, really excited to be with such a great panel here today. And let me just shortly introduce the names of the people we will have on the panel, but then they will go and introduce themselves. So we have Uli Grabenwarter, from the Deputy Director of Equity Investment at the European Investment Fund. Kanini Mutooni, Managing Director of the Draper Richards Kaplan Foundation from the UK. Rüdiger Wetzl-Piewald, CEO of Compuritas and Director of Social Business Club Styria, and Sanny Gaddafi, a techpreneur, founder of 8 Villages from Indonesia. So we have this internationality, and I think that's the most awesome part of this digital meetings, the ease of meeting people from across the world, and I love it really. So, without further ado, please, I would like Uli to start with a short introduction and statement, and then we will move forward. Uli, the stage is yours.
Thank you, and hi to everybody. Connecting from Luxembourg to the virtual city of Graz today, which is my hometown, as a matter of fact. So I feel particularly connected to this event, and hopefully it will in the future again be in real time. I would like to actually maybe start off with a couple of remarks on the impact investment space and how this connects to entrepreneurship in the large scale. Because we all know that impact investing is all over the place. It is all over the media. It's all over the conferences. It's all in the propaganda and marketing materials of all asset managers out there, because it happens to be the most sexy topic in the financial world these days, possibly because it makes the world of finance a little bit more human. It makes it a little bit more tangible for people that are struggling out there with real issues. And we all know that we are struggling with more real issues than ever before in our society. But when I address the concept of impact investing, I'd like to start maybe off with one important feature, probably the most important feature that I consider with respect to impact investing, and as a matter of fact, with all type of investments, which is that investment is just a means. It is not a purpose in itself. And I think this is a very important starting point of the discussion, because it places actually the relevance of the debate that we are having with you, the entrepreneurs that are out there in the market, because that is where the change is happening. We are merely an enabler of this change to happen, and we can create a means to make this change happen and influence the direction that our society is going by the dedication and the use of the money that we are making available. That is also something that is at the very heart of the activities that I am managing at the European Investment Fund, where I'm responsible for the entire investment activity in technology and innovation. And one could perfectly argue what does it have to do that social entrepreneurship and impact investing is part of that investment universe. Well, guess what? Social innovation and impact investing is probably part of the most important innovation elements that we need in today's society. And the objective of my role at EYIF is to continue to contribute to the building of an ecosystem that allows companies that are in that innovative space getting access to adequate funding so that they actually can realize and develop their business models. And we are doing that admittedly in a kind of indirect investment approach, because we are fund-of-fund investor. We are funding social venture funds and impact funds also on the environmental side that have in the investment strategy inherently the combination of societal objectives with financial return objectives in their investment thesis. And that is something that is very relevant and dear to us. I will not use too much of the airtime, because the purpose is to have a discussion amongst us and see that from different perspectives. But I would like to connect just to one thought that our previous speakers has left us with, which is the concept of growth and the relevance in an investment spectrum. I think the concept of growth in terms of investment success and business success is something that is indeed outdated. And I would even go further than Paul and say even the circular growth model is possibly outdated. The challenge that we are facing in any business model today is actually the question how we can monetize societal value that we create. Or in other terms, how can you as an entrepreneur, how can you as a social enterprise or an impact-driven enterprise create societal value that some stakeholder is ready to pay for? And that is basically the interaction that investment strategies in the impact investment space are centered around. And that is where you have a connecting point with impact-conscious investment investors and actors in the market that actually become more and more numberful as we speak. And in that respect, and that's maybe the starting point for the discussion that I'd like to launch. You may have perceived that in the past, having a social impact-driven business or a societal impact-driven business has been a kind of impediment to your fundraising process, because people were considering that you're doing something between running a business and running a charity. Going forward, the societal responsibility that any business is taking is going to be a key driver for the value that that business is going to create to investors. And from that perspective, if you look at it from today's point where you are and into the future, you're probably having a head start compared to any other business that is currently in the market. Thank you.
Thanks so much, Uli. Really good questions that you started here, and I'm really looking forward to discussing on it. Going into that is really, Kanini, you're heading venture philanthropy, which in itself is already, how do you explain that? What is it? So if you would like to share your thoughts, it's really interesting to hear more from you. Kanini, the stage is yours.
Thank you. Thank you, Selma, and thank you, Uli, for those great comments. Just to introduce myself, I'm Managing Director at Draper Kaplan. As Selma said, we are a venture philanthropy organization, and all that means is that we're doing two things. We invest on the impact investing side, so we're deploying commercial capital to early stage social enterprises, with a view to making a return, but principally with a view to making a social return and a social impact. And then on the other hand, we also do grant making to nonprofits. So, it's really combining those two arms within the same institution with a view to help solve the complex problems that we have in the world. That's basically what it is in a nutshell. just in terms of my background, it's just important to note that I also was an entrepreneur for 5 years. So I understand what it feels like to be setting up a new venture, trying to raise capital, trying to set up a business model that works, and also trying to align commercial and social interests and having investors who represent both sides. So I really do understand that part. And I think those are the best investors in the world, those who've really raised their own capital, run their own organizations, and are then now supporting other organizations to do the same thing. In addition to that, I was managing director at Tonic, which is the Global Impact Investors Network. We had about 300 investors deploying $18 billion in assets. So I've had the opportunity to really understand what it's like to talk to and be an impact investor, as well as understand the constraints that impact investors have. So don't forget, as a social entrepreneur, we as impact investors also have constraints. It's not just you. We're trying to deploy our capital, as Uli has said, in a way that helps solve societal challenges. And sometimes it's not that easy. So just maybe in terms of just quickly just giving some sort of tidbits for our discussion going forward, people keep asking, what is the difference between an impact investor and a regular investor? And as a social entrepreneur, you have to understand the difference because unfortunately, because impact investing has become so trendy, there are people who call themselves impact investors, but they are not. And what we're going to do today is I'm going to help you understand as a social entrepreneur what the key defining characteristics are in an impact investor. Because unfortunately, we do have impact washing. We definitely have entrepreneurs who sold their souls to investors who turned out to be simple commercial investors and who really did not have the underlying spirit of being an impact investor. That's the first thing. Now, the second thing that I think is really important is, as I mentioned earlier, we need you as social entrepreneurs because as impact investors, we're trying to deploy our capital to solve the complex problems in the world. And without you, we really can't do that on our own. So I think it's important to just remember that we need each other. This is not a hierarchy. It's all about us coming with a capital and determining who's going to get it. This should really be a co-creation marriage process between the social entrepreneur and the impact investor. And when you walk into a room with that mindset, trust me, things tend to go a bit better than when you imagine that the impact investor is all the way up there and you're a social entrepreneur sort of begging for capital for your entrepreneurial venture. So keep that in mind. We need each other. And then the third thing is, the only difference between an impact investor and a mainstream investor is that we think in 3 dimensions. We think in terms of risk, return, and impact. A mainstream investor thinks in 2 dimensions, risk and return. So we're also going to spend some time talking about what homework do you need to do as a social entrepreneur to understand what questions to ask us as impact investors. Because as I said, it's a co-creation process, and you need to do your homework in terms of understanding exactly what you're getting into and what you're getting yourself involved with. I'm excited to have this conversation and really looking forward to this discussion with this amazing group. Thank you.
Thanks a lot, Kanini. Awesome. Really, we're getting deep dive already. And I'm very happy that we'll go now into hearing from the entrepreneurs who themselves started these enterprises as that are solving issues and at the same time have to go through the process of if and how to fund it. And to hear already their experience is very exciting. And I would like to, Rudi, the stage is yours.
Thank you, Selma. Thanks a lot to Kanini as well, because it described already very well the different universes that are actually happening here. Just 2 sentences to my person as well. So I have found the Compuritas about 10 years already. It's 10 years ago. So it was a pioneer thing that time. It's still one of the most awarded in Europe. with sustainable awards. It's a refurbishment business, but I'm not going into that, obviously. There's two more things to think. I handed over my company 2 years ago. I did my private access, a totally unusual thing for a social entrepreneur. I will tell you why then. And then I became the director of the social business club Styria, which actually is an ecosystem organization, a regional ecosystem organization for social entrepreneurs in southern Styria. And I'm also board member of the Social Entrepreneurship Network Austria. So I'm also obviously very much into this topic. And seeing it from an entrepreneurial base, it is a difficult topic, obviously. First of all, and this is what Kanini already said, you really have to make this different view between regular investors and impact investors. And don't get me wrong, I think the 99% are the regular investors. This is important to know. We don't have figures for that. I would say the 99% yet is the one to say. And why this is important, because I think if you become an entrepreneur, social entrepreneur, you are obviously not so familiar with these differences. There's a lot of fuss about the investment world. We have TV shows for that. We have a lot of media coverage for investors, which is almost always not impact investment, obviously. So we have, and this is important for me to mention here, very quickly to say there's obviously, if you have a regular startup, you have, in a nutshell, you want to become successful, and yes, to put a cliche on this, you want to become rich, very quickly said. And this very well combines with the motivation of regular investors, because it's a kind of maximum profit for maximum risk, financial profit, obviously. And that's totally fair. That's totally okay, because you want to improve what you can have. You make money with money, which is totally fair. There's no problem with that for me. But what is interesting, because of this, there had been a standardization of the procedure of financing for the regular ones. Why I'm stressing on that? Because it's very different with the impact investment and the impact entrepreneurs as well. Because the typical rounds is you start with public fundings, then you go on with business angels, then you have your venture capital rounds 1, 2, 3, and in the end, everyone is seeing the exit. And then hopefully it happens, everyone is happy. It's happening very rarely, important to say. Why is this different now with the impact investors, but especially also with the impact entrepreneurs? Because an impact entrepreneur has a very different motivation, obviously. I also like to say, a little ironically, yeah, we like to save the world. I always like to say the social entrepreneurs do not save the world, but they are showing how to do it. But they have very different motivation, and they do not think in exits. They have come to stay, actually, because it's their mission, it's their vision, it's their mission. This is how they want to spend the rest of their lives, in best case, doing good things, producing good solutions for everyone. So, and this is now coming together with impact investors. And I tell you from my own experience, it's 10 years of experience by now, we still have a gap. I see the big gap. In a way, there are the same motivations to really scale up the impact, which is very important, because small impact stays small, is important, but it's not big enough. But we might have very different experiences about how to scale up. And I tend to say, and I take this very positively, investors, impact investors are very good in making business and scaling up business. Entrepreneurs are not, especially not in the beginning. And I give you just one example for a stop here. When we started our business, there was always fully impact driven, but obviously also on the financial impact. This is very important. Yeah, we have these three aspects. We have it, the environmental profit, the social profit, and the financial profit. Obviously, this is the columns we talk about, and all of them are at the same level. But if we say we wanted to grow a healthy business, you have to think, because you don't think in exits, you don't think in maximum risk. You want to have growing a healthy business, and the investors view very often, I have to say, also the impact investors, yeah, but we have to scale it up big side, otherwise it's not having the impact. So this is an ambivalence one has to think about. And one of the main questions I will put in here for both sides, And I would ask as well, the impact investors here as well, the specialists, when is the right time for the investor to start with impact investment in the social entrepreneur, social business, and when is the right time for the entrepreneurs themselves? Because very often we are talking about different stories here. So I would like to see a little more going deeper in this topic here. Thanks.
Thanks a lot, Rudy. Questions, interesting questions, a lot of discussions. It's got to be short on time. I would like to give now the opportunity to Sanny. You are a tech entrepreneur, but a social entrepreneur. Where is it really that you're standing? And then we will go on fast Q&As, I hope. Please, Sanny, the stage is yours.
Yeah, thank you. Hi, everyone. Good morning. Good evening in Indonesia. My name is Sanny. I'm the founder of 8 Villages. So we are a technology company that very focused on modernization villages. We try to create some solution that very specifically targeted to the smallholder farmers. So we start since 2012 at that time with angel investors, the one that really like the idea on how we can connect farmers to information. 2012 is also very hard to convince people to invest, including the angel investor, because smartphone is very expensive at that time, and we only rely on simple mobile phone. But yeah, we have some support from friends and family also on that one. But still, to grow, we need funding, and it's hard. I think 2012 in Indonesia there's no impact investors. It's hard for us to find investment, but we see like there's a lot of NGO that want to start to introduce technology for this community, which is agriculture. So we try to find a grant. So we see like social entrepreneur sometimes only looking at the social investors, social impact investor. I mean, but I think there's also one more funding source that we can find, and it's available everywhere publicly as long as we want to search it. We can see it, which is the grants. And 2013 we have. We receive a grant to help us to improve our product and do some POC on the ground and meet the farmers. As you know, Indonesia is thousands island. It requires big capital to approach farmers in the rural area, and we get a lot of help on that one. But still, to be honest, at the end of the day, investors don't like us. Because when we meet them, what they ask is, so how do you charge your farmers? No, we're not charging anything for our farmers. And how do you make money? Well, wait, we're not trying to do that right away. I mean, if we want to charge them $1, we need to help them to make $2 first. So this is our phase. That is why we have to partner to collaborate with others with finding a grant that fits with our vision and run from there. And at the end of the day, all the NGOs or all the grant provider looking for sustainability of the project after the grant ended. So that is our position as a technology company, to make sure that after the project, the activity is not just because there's a funding. So our position is to make sure that the project can be sustainable by creating an economic wheel on top of this project right away before the project is ended. And when the project is ended, the community that we already gathered together in that project can quote unquote paying 8 villages by doing some transaction. Now, 8 villages, besides helping farmers to get information, we also connect them to market. So there will be a transaction, and we receive a margin from there. And that's and we keep connect with our previous funders. I mean, the funders itself. We keep report our activity, and by making sure that the project is sustainable, usually the NGO keep coming back to us and coming with, hey, Sanny, we have another challenge here. Can we do this and that? And it's excited us because there are a lot of innovation happening in that model, and we receive we receive a good support on the grant, and we make sure that the activity can be sustainable on the business model. And we keep, after the project end, we will make sure that the activity still running, even though there's no funding involved.
Thank you, Sanny. Interesting, also introducing the concept of patient capital. But we will discuss that. I will just like to have everybody, we have about, to inform everybody, we have about 40 minutes for the discussion. If you have any questions or comments, please post them in the chat and we will receive them and we'll be able to answer your questions. I would like, Uli, when you're running the EYIF, you're running the fund of funds. Basically what happens with that is you are creating the policy for larger funds, because if you fund them, this is how they fund others. So how do you see really your role, and how have you seen the change in the last few years? You mentioned that it's in now to be in impact investing. Is it really true? Do you see that it's a large majority, or is it just a small part of the investment field is in impact investing?
Well, I think the change that we've seen over the last 5 to 7 years is actually massive in that respect. And we launched our first fund of funds generation in 2013. And at that time, I can tell you, when we were trying to back social venture funds, we basically have been providing at least half of the capital of the fund in order to get them off the ground. And very frequently, we got them off the ground at the minimum size that they needed to sustain their own operations, because obviously, a social venture fund, they also have to have a management team that needs to live from something. So that is a cost factor, and you need to have something that keeps the balance between how much capital do you have to invest and how much do you burn for your own operations. And that's a tricky question, but that's not a topic for today. What I wanted to maybe point out is in 2013, we have basically been the rainmaker in the market for social venture funds to happen in the first place. And we have, in the course of this exercise, seen the first structures emerging that were big enough to actually have a sustainable investment activity in social enterprises. But they've been pretty much on their own, investing in a very confined investment space. Over this period of 7 years, what have we observed? We observed on one side that they are no longer in their own space. Meaning that they have managed to back companies that have grown so significantly in their investment in their operating activities that in later financing rounds, mainstream venture capital funds got interested in backing those companies, because the growth potential and the value proposition that those businesses could bring to the market have been so convincing and so pertinent that they became interesting for the mainstream markets. And more importantly, what we've seen in the recent past is that even mainstream venture funds investing in so-called mainstream businesses have taken on board social venture funds in financing rounds of their mainstream businesses in order to introduce impact components in the business models of enterprises, because they've understood that this has become a massive competitive factor in the value creation process. And I think that is the kind of shift that we are seeing in the market, and that goes beyond counting how much money goes into what market segment. It is it's a mindset shift that we are seeing, and I think. With the examples that have been given, how investors approach entrepreneurs and ask, so where do you make your money? How are you going to pay our returns and things like that? Obviously, you still have this type of investors out there in the market, and you will continue having them for quite some time, because as long as there is an opportunity that you can make money with that type of investment approach, there will be a community that will go after that. But what we are seeing is that the diversity of the investment audience out there in the market is growing by the day, and that we are shifting away from a profit orientation in business models and in investment models to a value creation approach in creating businesses, in creating investment themes. And I think that is a very important features that we have to observe and that we have to look at. I think the question of how do you make the money, who is going to pay for you, it's something that we unfairly hold against social enterprises because their business model is to create a combined value. But if you look at it, and if you're very honest, even in the mainstream markets, we have this approach already implemented since a very long time. Give me one example of one user of Facebook who pays for using Facebook. Nobody does. But they actually make value because they trade a different currency, which is the information that they have access to. And they also have a different stakeholder community that is not linked to them in a clear user provider relationship or seller buyer relationship, but they are actually in a triangular business relationship where a third party pays for value that is meaningful to them. And the same thing actually can apply to any social enterprise, because if we are solving societal issues, somebody in this society must have an interest for this issue to be solved and must attribute value to this issue to being solved. And this value that is attributed to solving societal issues, that is the challenge for social enterprises, to seek ways how to monetize it.
Awesome. Really creating new business models and how everything is seen. We definitely have seen now in the crisis, especially that entrepreneurs, companies, businesses who have more of a social aspect or clearer branding of caring have done much better than companies that were purely profit oriented in terms of their brand. I see, Kanini, you would like to comment on this, and definitely please do go into the details of how do impact investors really think?
Yeah, no, I just wanted to raise my my sort of, I guess, my view around, I think Sanny mentioned this around return and the fact that, you know, he was being asked by potential investors, you know, are you charging the farmer? So just taking a step back, as impact investors, we are out to make a return, okay? And I think that must be clear for everybody. And I think, Uli, you've alluded to this. We're out to make a return that is social and financial in nature. The difference is what level of return are we looking for in proportion to market? So are we looking for at market return? Are we looking at above market return? Are we looking at below market return? And for me, sometimes this is the key question that starts to differentiate a mainstream investor from an impact investor. So from our perspective, we're happy to make below market returns as long as there's a huge social and environmental impact that comes out from the capital that we're deploying. So I just want to make that really clear, because I think there's a mindset that impact investors are happy not to make money. No, that is not an impact investor. That is a philanthropist. And sometimes we get mixed up in the terms, and then, you know, we have conversations with social enterprises who really don't see the difference here. So I think that's the first thing. What level of market return are we looking for? And what level are we comfortable with as impact investors? And then secondly, the exit question that Sanny mentioned, Uli sort of alluded to as well. We want exits as impact investors. I mean, why not? I mean, that is a form of sustainability, but it comes down to how long are you willing to wait for that exit? How long are you willing to wait for you to get your capital back? And Selma, you've alluded to this in terms of patient capital. Again, another very clear distinction between a mainstream investor and an impact investor is ask them, when do you expect to get your capital back? Anything less than 10 years, in my humble opinion, is a mainstream investor. Sorry. anything less than 10 years is a mainstream investor, because patient capital should be willing and happy to wait for an extended period of time when we're earning social returns, but not necessarily financial returns. Now, as soon as we get our minds around this, then we start to understand the real value of patient capital in helping solve complex problems. Because the problems that Sanny is trying to solve around the smallholder farmer, around livelihoods, cannot be solved in 5 years. I mean, for goodness sake, it's just not possible. So again, extended holding periods for me is a clear indicator that this is a patient impact investor with patient capital. And secondly, exits are not bad. It's just about when they happen and how much pressure as impact investors we're putting on the entrepreneur to make the exit happen. Because I have seen scenarios where impact investors are hugely pressurizing the entrepreneur to an extent that the entrepreneur starts to move away from their mission. And that's when we really start to have a problem. When you have mission creep because financial return overtakes the need for social return. So, you can probably see I'm quite jaded. I've been in this space for so long and I've seen the good and the bad, but I really feel that as impact investors, we really need to be honest about what some, colleagues are doing, some of our peers are doing to protect the social entrepreneur.
Thank you, Kanini. Really awesome to hear what you just said. And it's I would like to just go shortly into that when you said that the entrepreneurs need to ask. And this is something that we have been discussing, and I've been talking a lot about this lately or in the last years, is the need for entrepreneurs to do the due diligence on the investors, no matter at what level that is, if that's a business angel, a fund, whatever the VC or whatever the stage, or venture philanthropist, whatever. But you need to do a due diligence as much as the investor does a due diligence of yourself. You need to find out who do you really want, what values do you have, and to make sure that your investors share the same value, exactly the timing, for example, of the exit, which is absolutely crucial in the success of a togetherness of this marriage between, let's be honest, it's sometimes more difficult to get out of that marriage than from a regular one. So you might consider, as Kanini mentioned earlier, how important it is, this partnership, and Uli was talking about this partnership of coming together and being at the same level, but making sure that and you do not go and seek the most popular, the most visible or whatever investor that is out there in the market, but make sure that you seek and find the investor that really fits your needs in terms of the knowledge and the experience, the network, and of course the money and their views on investment. I would like to, Uli, you have, but we start with Rudi has a comment.
Yes, thank you. I was just thinking, again, this topic about what is the main goals that we actually have as impact entrepreneurs as well. And yes, sometimes this is a moral question as well. I have learned that obviously it's not possible with one small, cozy company. You are not making that impact that you maybe have planned at the beginning. So there are two ways to do it, though. The first way, obviously, is, just being successful as a social entrepreneur, scale up your operations, become bigger and bigger, and maybe one day, and this is hardly happening, but also in a regular economy, you have your own corporation, who knows, making big impact in a market that is much bigger than you. So this is the one way, I think, that we far too often think in these terms of how to grow your impact, that really almost bet the money on individual entrepreneurs and their companies to make this flip in economy. And I think this is very important for me to see if you really, I come from the tech industry myself, electronics industry here. And it was interesting to see the beginning. Okay, what is the problem of the industry? And there's a huge problems in the whole value chain, for example, in the whole electronics industry. So the idea was how to shift that. And there was a lot of pioneer work, still up to the day. This is okay. This is your role that you have. But it was a very interesting piece of knowledge to gain what is the real impact that has happened? I can tell you for our example, when we started in Austria about 10 years ago now, it was the only company starting with such a strange kind of computer refurbishment business. This was something totally new, not only in Austria, obviously. And as it has to be, no one was caring. The rest of the industry was ignoring it. But what has happened, and this is the most important thing, and this is the second way of growing impact, number one, and I think the more rewarding one, from the moment that our company actually made this very important proof, and this is the proof that social entrepreneurs do, that you really can combine impact goals with profitable goals. You make profit in different ways, but you have a profitable business. From that moment on, actually, I can tell you in the moment we have about 25 companies doing the same thing in Austria only. And they have a share of the market, which is far bigger, obviously. And if you ask me if this is a problem with competition, I would say if you think in competition, you're not a social entrepreneur very easy, because you have to think in changing things. And this is going to happen. And we have a prognosis that our industry that we work in has about 25 to 30% of the chance to change the market, to make it sustainable. And this, I think, is what might be interesting in terms of investment as well. So what is the real impact that you're growing? And if you're only thinking in individual companies, and this is a high risk, it's a high risk, definitely not less risk in social businesses, investing in social businesses than in regular businesses. But what I like to say here, I would prefer to see a lot of investments in the small companies. Some of them will make it, some of them not. But don't take it too much on the effect on the single company and the success. Actually, it's the huge success afterwards. I give you one more small example, which is very easy to catch. For decades, it was very obvious food delivery is a motorized thing. Huh? Very interesting. We had in Graz, where I come from, a company that started as the first mover in this market to say, and this is so clear, pure social entrepreneurs, very successful, we cannot see anymore that every pizza has to be delivered by a car. What a madness. And they started with this, I think 7 years ago already, we do all by bike. Yeah, they became incredibly successful because obviously it was a trend in time again to see this. They did it very smart. And what happened 2 years later, the market leaders in Graz first started to copy them. I think it's very hard to get your pizza without a bicycle today. But it needed those pioneers. And why this is important, I think a very important role for impact investors is to really foster this type of change, but not on your own risk. That's not the topic here, because then it's just giving away money. It's fundraising, what you can do then. That's not what the case is. But really foster the entrepreneurs as well to see their own social profit, to really measure their own social profit, and as the impact investors, to fully take into consideration this type of profits that are made. And this is where different types of profits altogether, they make at least the same profit as a regular company as well. But this is a different perspective to me. Yep.
Awesome. It's really how the impact is made, not only by the one company you invest into, but the larger impact that it has. Uri, you wanted to make a comment earlier.
Yes, thank you. And I wanted to react to a couple of thoughts that Kanini shared with us. As much as I understand where she's coming from, to kind of seek the authenticity of investors when they approach impact investment opportunities, I think we should be careful in trying to categorize impact investors. For the simple reason, because even the concept of impact or social impact, as a matter of fact, is a very unclearly defined notion in the space. Actually, we may possibly agree amongst us what we consider as being socially relevant or not relevant, or good or bad. But I think if we pushed it to the details of the discussion, we would even find out that amongst us we are not able to find a common denominator. So I think the most important feature actually in impact investing is not a question of what is good, what is bad, what is short-term, what is long-term, what are noble reasons to pursue profit, what are less noble reasons to pursue profit. It is a question of creating transparency. Creating transparency so that every stakeholder in the ecosystem, be it an entrepreneur, be it a consumer, be it a supplier, be it an investor, has actually all the information available to judge whether a business that is created is in tune with the value set of values that actually is relevant to the stakeholder. And I think that is if we try and manage to move the discussion into that space, let us create a transparency that allows everybody to communicate clearly about intentions. Then many of those questions of whether this is on this side of the fence or on that side of the fence is going to go away. As a matter of fact, we cannot afford those fences because the capital that we need to mobilize to solve our societal issues spans far beyond any boundaries that we may create between philanthropy and return compromising investors and impact investors and mainstream investors and hedge fund sharks and what we have out there. So we need to find ways to make those different market segments communicate and join forces with respect to common objectives that are pursued through the business model of a company. And if we manage to do that, we will get a company funded. And that brings me to the second point that I wanted to comment on, which is the question of are impact investors compromising on return? Are they compromising on financial return? And what is market return? In my capacity as private individual, actually, I'm investing in venture capital myself. 90% of my personal assets are in venture capital in life sciences. And I'm backing companies like doing research on a cure against Alzheimer's disease. I know about this investment space that there have been roughly 4,000 molecules that went into clinical research against Alzheimer's to date. And not one single came out successfully. So what is the market return that I should ask for this investment? Is it 5%, 50, 500, 5,000, 5 million%? You see, it is a question of a value affinity that an investor takes with a business model of a company that will ultimately decide whether that investor is ready to back that company or not. And the same actually applies for the funding perspective of an entrepreneur. If you as an entrepreneur can get 100% of the money that you need to conduct your business for free in terms of grants or things like that, of course you will take it. Why would you pay for capital as an ingredient to your business model if you can get this ingredient for free? It's only when you find out that the money that is accessible to you to fund your business for free is not sufficient to conduct your business and to move it to scale and to do whatever you want with your business, then you will start looking for funding sources that will give you money for an incremental cost. And you will pay the minimal incremental cost until you actually get your business model funded. And I think it is in that way that we need to think about investing and about money. It is just an ingredient in a production process. And that's the way how we need to approach it.
Thank you, Uli. Really, really interesting points here. I would especially like to point out the transparency idea, and you have earlier already spoken about the mindset, and it is how, and when we talk about the investments that you are making as a private person, it is really about having regular companies as we see them, changing and becoming transparent on one hand, but also starting to measure the impact that they are making. We see a lot of companies that are out there doing amazing, fantastic impact and great work who do not see themselves as creating an impact in those terms and are not measuring what they are doing. The moment they start measuring, then I suppose it is the moment when it becomes for investors to see how much of that impact is made. And that is what I see as the big difference between that. I don't know if Kanini, you've raised the hand again, or can I give the floor to Sanny just to comment on how they proceeded in funding?
No, actually, I wanted us to focus a bit more because I think this is the typical thing that impact investors do. We get into these great discussions about what it means, holding periods. But I'd love us to just focus a little bit now on supporting the social entrepreneur in terms of tips, practical approaches that can help them access the capital. Because I know Uli and I could probably go on for 3 hours on these great topics. But that's actually what I wanted the discussion to move to now. Great.
Great. Moving to Sanny to tell you, how did you proceed and how did you work, especially as Uli has said now on moving from grants into other ways of funding.
Yeah, I totally agree with Uli, what Uli said. I mean, yeah, maybe the term is the ingredient to move forward to scale. And when there's a time to replicate, when we find a way for us to replicate this by ourselves without depend on the grant, then there is a time for us to get funded. I'm not saying that I don't receive any funding from investors. I'm just saying that on 2013, yes, investors don't like us because maybe it's because we cannot explain to them on how we make money when they assume that we're going to take money from the farmers, right? But as we learn ourselves, as we get supported by the grant and we do a lot of pivot, we find a way on how to make a cash cow on our technology, even though it's not related to agriculture, but the technology is being used for other purpose, and we can sell this as a SaaS for companies. Then it allows us to find a way on how we can make how we can go back again to our first vision, which is helping smallholder farmers. And in 2017, it's something that we feel like now we are more confident on how to really make money. We can show to the impact investor or even VC that we can make money. But the one that is not paying us is farmer is not the one that's going to pay us, but the consumer, the buyer side. So from that kind of model, we feel like supposed to be 2019, we align everything again, and we feel like we still can sufficient to fund it, to make it sustainable in our business. And supposed to be 2020 is for us, hey, let's scale this by ourselves rather than wait for a grant. With grant, that means that we need to follow where are the area that's supposed to get affected, right? But we already know which area that we can approach, have a good potential to scale and making business by ourselves, and we feel like that is the right time for us to find and actually we don't need to find the investor. They already heard us, they already offer us, and we feel like it's a good opportunity, but that's supposed to be this year. But because of the COVID, we feel like let's just stop and realign again and reflect ourselves which one is the best. Maybe this is also a good momentum for us to see which one is the best revenue source for our company before maybe next year we meet the investors. I hope that answering your questions.
Thank you. I suppose this is what we always say, the best investor is a paying client. So maybe we go, that is definitely something everybody should focus on. But there is a question. So we have about 20 minutes left, approximately, a bit more. I would like to really go now into short answers. And as Kanini said, to make sure that it is clear tips and tricks and what we can say to entrepreneurs on how can they move. We have a question from the audience, which was about the role of ESGs. And maybe, Kanini, you can just go shortly on that, and then we really kind of go into tips and tricks on how we can support entrepreneurs, what they need to look for, and how they can work. Kanini, the stage is yours.
So thank you, Selma. Great question on ESG. I think just to put it in a simple way, the way we see ESG is ESG is simply a screening mechanism. It's using a screen for an investor to determine where he's going to deploy his capital or her capital. So a typical example would be an investor could say they're not going to invest in pornography or in contraception or in the tobacco industry. That's a very basic filter that an investor will use, and it's completely different from impact investing. So impact investing is going beyond the screen and now going into depth and asking additional questions around, okay, for this particular company, how is it going to positively impact, say, its stakeholders that it's dealing with, its employees, and the environment? So it's really going much more in depth, looking for intentionality, looking for impact measurement, and looking for sustainability in the long run. So just in a simple way, ESG is the starting point, and using an impact lens is really the next stage. And be careful as an entrepreneur when an investor says they use an ESG filter. They're only just using a filter. In most cases, it stops at the filter level and it doesn't go into more depth than that. Just in terms of thinking about the tips, I think one primary question that we haven't talked about here is the entrepreneur needs to ask the question, what are you going to give me over and above your capital? It's not just about capital at the end of the day. I mean, I know Sanny and Rudy will really understand this, that we do this at DRK. We provide in-depth, hands-on support for a period of time when our capital is deployed around helping the organization hire talent and get the best CFO possible. How do we help them have an effective board that is actually going to help the organization to scale and really scale, well from a financial and an impact perspective? We help the organization identify new markets, for example, that they need to get into. So, ultimately, we seem to think money is everything, but it really isn't. And as an entrepreneur, my primary criteria was, if you're just going to write me a check, there's so many people that can give me a check. What I need from you is intellectual capital, social capital, everything else that is non-financial. So just make sure you ask that question and get clarity around it. And then just one other thing around tips and questions. Ask how the impact investor sees impact. It's a very basic question, but you'll be so shocked by some of the answers you'll get, especially from impact investors who, as Uli said, haven't been transparent and haven't really thought about how they perceive impact. I'll give you an example. I've heard in a room an investor saying, oh, we invest in sub-Saharan Africa, so obviously we're impact investors. No, you're not. Investing in a certain geographical region doesn't automatically give you the credentials of an impact investor. There's got to be intentionality, as has been mentioned. There's got to be a mindset around systemic change that I think Rudy really, really put across excellently. It's not about just impact from one organization. It's with our capital, how are we going to help change the whole system? And how do we explain that as impact investors? So please do ask that question. How do you see impact as an impact investor? And what do you expect from me as your investee in terms of being able to measure my social impact?
Lovely discussion. This is great, really awesome. You mentioned, Rudy, I would like to hear more about the work you're doing with the Social Business Club, or how do you support entrepreneurs and how do you help them? Is investing part of that, or what you really do and how do you work?
I would say investing is the only part we don't do. Not yet. In general, it's almost homegrown community. It started about 7 years ago at the university, local university. There was lectures about the topic on impact, entrepreneurship, and there was so much interest from the students that after 1 year there was an organization started with it, and I can tell you we are having a network about 120 social entrepreneurs in a very small region. This is important to say. So we do a lot about reporting and a lot of direct support. This is very important to say. This is maybe one of our real benefits, that coming directly from the social entrepreneurial sector, you have a different understanding about what might be needed. I always say we come from the practical field. That's the easy part. That doesn't say that the others are not important. They're definitely very important. Everyone has a role, but it makes you see things through another glass. And we do, for example, a lot of coachings. And one of the most important coachings, just to give an idea, is obviously to tell people what is a real good business model. And believe it or not, social entrepreneurs know this discussion. Is it okay to earn money with what I do? This is always the first thing to come over, that we have to explain to so many potential and entrepreneurs. It's totally okay that you have a business model, that you earn money. And who is paying? I'm here with Sanny. There's a question, yeah? Who is the one who is actually being charged for that? But it needs to be professional. It needs to have a business model. It needs all the skills. I would say maybe 80% of those skills that we deliver are probably the same skills that every entrepreneur needs out there. You have to have a good command of pitching, obviously. You have to have the skills for storytelling much more probably in impact terms, but it is so important to really show the world this is why it makes sense here, because you cannot prove that we all going to become millionaires in 3 years. That's not working in our industries. So that's a lot about education. We are going to start our own Impact Hub next year, by the way. It's really first-hand information from entrepreneurs to entrepreneurs. And talking about tips here, this is also, I've made a small list here as well. I would also say, first thing first, always make use of public fundings as much as available and as much as useful. What we don't like to see is obviously entrepreneurs. That means entrepreneurs who hop from grant to grant but never get to business. This is not a good way to start. What is interesting, maybe, I don't know about your experiences, but unlike regular tech startups, for example, impact startups are very quickly to go to market. Normally it takes less than 1 year for them. This has two reasons. The first reason is there's no one giving them the money they need, or at least there are no long research programs where they get the money before they have even a prototype. They need to have income. And the second is, and this is what I like, they really want to make impact from the first day on, because it's their most intrinsic motivation. And this is something to keep up a lot. We have quite a lot examples, especially from tech startups, tech for good startups, as we call them, obviously, which went to the regular way. And one day they had to decide. They had to decide mainly from the pressure of investors. So do you want to keep up the business part, or do you want to have the sustainable part? Because both is not interesting for us. Talking about regular investors, obviously, it's very important. But there's a decision making. There have been a lot of dropouts because of this, which doesn't make sense. Second would be a very handy way of investment is obviously crowd investment in the beginning, because it's not about huge sums. It is obviously money to pay back. In the meantime, it's quite high interest rates to pay as well. It was different 10 years ago. But what you can do here, and this is, I would even say, a good weapon for social entrepreneurs, you really need people who are convinced about your mission and your product. And this is not only fools, family, and friends. This is actually people you can really ignite with your mission. And this works quite well with fundings, crowdfunding, but also with crowd investing. We did ourselves too. To campaigns here. It's a lot of work, but it's rewarding because it's your customers that you build up, your customer base. And I think I'm not wrong saying every investor and also every impact investor likes to be approached with a running business model already, because the risk is far less obvious. And now it's about scaling up. So that was my question at the beginning as well. What is the right time for receiving investments. It's the right time if the public fundings have been taken to a certain degree. If obviously the need for more money is there, more money than you would get from the regular ways, money that you cannot earn by business only. And then it's really about giving proof already. I think this is the most important thing. I liked what Kanini says about, crowd, and not only crowd investment, but impact investment is 10 years up. This is a very good test. If you tell an investor it needs at least 10 years to get your money back, I think it's the first question you should ask. And later, let's look. Though I totally understand if the investor said it's madness, because if a regular view, it's madness, definitely. So set up your own profitable business because it really keeps your own independence. That's very important. This is what I like so much about the entrepreneurial approach. Otherwise, we can just make non-profits. Fair enough, but this is a different way of making impact. Really having your own entrepreneurial independency is most importantly if you want to make new innovations, because every entrepreneur starts with one single product or service, but you become your own expert by time. And by time, that means you have a whole new range of new innovations within your impact sector. And this is so important. This is, I think, very important, prove me wrong, for investors as well, because scaling up in the long term does all the work if you really have a constant line of innovation.
Thank you, Rudi. A lot of information again. We are closing up the session. I would like to, each of you has been able to give at least one tip to the entrepreneurs, and I would like to, Uli, to finish up the panel. I don't know if there are any further questions. If not, I will tell us, but we need to round up. I'm sure that each of the panelists, you will be able, if you are listening here today, you will be able to reach out to them. They are here to talk to you, to help you, to support you. That's why we all spend time on panels like this, is to provide information, but you need to ask and go for it. If you sit back and kind of expect everybody to come to you, that will not happen. So being an entrepreneur, go out and ask the panelists about anything you care about. And I would like Uli to give a final statement, your tips to entrepreneurs, how to reach and when to reach to investment. If I may say before that, it's like, to me, seeking an investor is a matter of scaling. And that's something that, so you do have to have a market. There must be something approved. There must be a need that you're really solving before you go to investors. Time have also changed in terms of investors, not grant givers, but investors. But Uli, you as the big EYIF funding the funds that are creating really the opportunities for in entrepreneurs, please, for your final statement.
Well, I think a lot has been said and a lot has been given to the audience already to digest. I think my two recommendations or my two thoughts that I would like to give everybody with them on the journey is, first of all, the difference between a normal entrepreneur in quote marks and a impact entrepreneur, a social entrepreneur. I think it has been said before that 80% of the qualities are the same. I think 100% of the qualities are the same, except that you need one more, which is the impact consciousness. And I think that is the biggest asset that you can bring to the table in making things happen. And then when it comes to the value proposition that you bring to the different stakeholders, be it your consumer community, be it the beneficiaries from your business model that you're working with, be it other stakeholders in the regulatory space or in the public sector space, or be it investors, whenever you approach your business model and try to craft it, think of how you can actually create monetized value out of the value proposition. Who is ready to pay for what you're having at stake? I think that would be my advice.
Awesome. So it's really, again, it's about being an entrepreneur, a passionate, full-blown entrepreneur. And then we know that money follows idea. If it's a good business, then it's a good business idea, there will be money coming in. So as I said, reach out to everybody. It's been an awesome pleasure to be moderating this panel. As Kanini said, we could spend probably another 2 hours on this or 3 days, no matter. Please, Nora, it is up to you to finish up this panel. Thank you very much for the opportunity, and thanks a lot to my panelists.